We have just finished going through Vistra Corp's FY2026 second quarter earnings call materials, and now we want to share our takeaways with everyone. If everyone says AI is about to eat the power grid alive, why is wholesale power in Texas moving the wrong direction? I've watched power markets a long time, and this one rewards patience, so let me walk you through it step by step. The physical side of this business just had a monster quarter. The pricing side is quietly telling a different story. Both are true at once, and that's what makes this one interesting. Start with what the company actually put on the board. The company reported $1.76 billion of adjusted EBITDA for the quarter, up more than 30% year over year. Right next to it, the company's stated fleet commercial availability ran at 97% straight through historic July heat waves. Sit with that pairing for a second, because it means more together than either number does alone. Making power in the hours the grid is screaming for it is the whole job, and they did it. Now the other side of the ledger. The company's FY2027 adjusted EBITDA target sits at $7.4 to $7 billion, and management notes expectations will trend toward the lower bound because ERCOT forward power curves are softening, so the machines performed and the price assumptions for 2027 quietly slid down. Our take is that this quarter is not a beat story or a miss story at all. It's a disconnect story. Hold on to that word, because every page after this one is a variation on it. The company describes this business as two legs that hold each other up. One leg is generation, the farm with assets across nuclear, gas, coal, and solar, and the company put its Q2 contribution at $994 million of adjusted EBITDA. The other leg is retail, the supermarket, selling directly to homes and businesses, contributing $773 million of adjusted EBITDA. Sitting over both of them is strategic hedging and risk management. The company's own logic is stated plainly here that when wholesale prices drop, generation takes a hit, but retail procurement costs plummet at the same time. Think about your neighborhood diner that also owns the farm the eggs come from. When egg prices crash, the farm side hurts, and the kitchen side suddenly prints money on every omelette. You don't get rich either way, but you don't get killed either. By industry logic, that's the entire point of an integrated merchant power company. We suspect this structure is the least appreciated thing about the name, right up until a quarter where prices collapse. And this quarter, prices collapsed. Here's the grid the company draws, and it's worth walking slowly. A pure generator captures massive profit when wholesale prices are high, and faces severe financial distress when they're low. A pure retailer is the mirror image, squeezed by procurement costs when prices are high, capturing high profit when they're low. The integrated model claims stable earnings in both columns. To be fair to the pure players, that stability cuts both ways because you give up the blowout quarters too. And here's the test the company puts underneath it. ERCOT wholesale prices crashed to $30 per ambulatory in the quarter. A pure generator would face distress at that level, yet the company's retail segment held at $773 million, while hedging secured a 5% year-over-year realized price increase. That's not a theory anymore. That's the theory getting stress tested in real time and holding. Quick word before we keep going. What Radar actually trades through is interactive brokers, mainly because one account reaches the US, Japan, and the other majors. The link is in the description if you want one. Straight with you, paid promotion. We're a customer, they pay per click. Not advice, investing carries risk, do your own work. Alright, back to it. The company puts fleet availability at 97%, while PJM peak demand ran above 168 GW and ERCOT above 91 GW in July. Those are the hours that decide a whole year, and the fleet showed up for them. The company credits three things for its strategic hedging, where realized price per MWh increased by about 5% year over year. Asset optimization, with PJM capacity revenues up and flexible gas plant curves optimized. And fleet expansion, the Martin Lake 1 restart plus integration of the Lotus assets. Underneath all of it, the company stated that 3 nuclear refuelings and 92 planned outages were completed before the heat wave arrived. Pay attention to that last line, because it's the least glamorous thing here and probably the most important. Getting 92 outages done before the hottest weeks of the year is work that started months earlier. Our read is that this is the piece of the story you can genuinely underwrite. Availability is management's to control, and they controlled it. Price is not theirs to control, and that's where the argument actually starts. This is the page I'd hand a new analyst and say read it twice. On paper, the FY2027 range is untouched, still $7.4 to $7.8 billion with a 7.6 midpoint. But the company's own framing is that benchmarked against October 2025 forward curves, ERCOT weakness pulls expectations toward the bottom edge. The company's line is blunt, that investors purely reading the table will miss the true signal. To be fair, the company has a real point in its defense here. They didn't cut anything, and there's a genuine offset sitting off the page. The company explicitly noted that Cogentrix's acquisition synergies and meta PPA premiums could add roughly $700 million to FY2027, kept out of official guidance until the deals officially close. So you've got a quiet downshift inside the range and a quiet upside outside of it, and neither one shows up in the headline number. Our take is that this is honest disclosure telling you something uncomfortable in a voice most people won't hear. I'm maybe 70% on the read that FY27 lands in the bottom half. Now the company does something I didn't expect, which is talk the story down. The market narrative is a 400 GW interconnection queue. The company's own reality is 12 to 15 GW by 2030, and the company states the queue is inflated many times over by speculative filings, with its internal forecast unchanged since May 2024. I'll own this one. I took the queue headline at face value a couple years back, and it turned out to be a waiting list. The company also breaks down where load growth actually comes from. Of ERCOT's 5 to 6% growth, AI and data centers account for about 2%, and the traditional economy, oil and gas, residential, commercial, and electrification accounts for about 3%. The company adds that data centers will not become the primary driver of Texas load growth until after 2028. The bulls will push back that this is management sandbagging its own story so it can beat later. Our take is the opposite. A company refusing to sell you the hype number is telling you how it prices risk. Here's the argument that ties the whole deck together. The company states that ERCOT wholesale prices are stagnant at $30 per MW, while new construction costs run at 2 to 3 times equipment cost inflation. At $30, nobody can afford to build new generation, and the company says that plainly. Yet large customers urgently need power, right now, not in 5 years. So what's the result? The company's answer is that customers are willing to pay a premium for long-term PPAs on the existing fleet because it stays significantly cheaper and faster than funding a new build. Cost inflation, the thing that hurts almost every industrial business on earth, is being framed here as the moat. Every dollar that construction costs go up is another dollar of scarcity value sitting on plants that are already standing. By industry logic, we think that holds with one condition attached. It only holds while the existing fleet is scarce. The day someone finds a cheap way to add capacity, the premium is gone, and I don't see that day yet. This page is the best explanation in the deck for why the price looks so bad. On July 22, the company describes the ERCOT grid as dangerously tight as solar faded into the evening. The numbers on the page are supply capacity of 31 GW against demand of 25 GW, which the company calls the razor's edge. The company's stated expectation was that prices should have cleared at $400 per MW or higher. The actual clearing price was $57 per MW. The company's explanation is that battery operators, fearing stranded charge and suffering from recency bias, raced to discharge simultaneously and crushed the price. Everyone hit sell at the same moment because nobody wanted to be last one holding electrons. The company's conclusion is that the current low price reflects misaligned battery behavior, not an abundance of physical supply. Our take is that this is the most important and most fragile claim in the whole deck. If they're right, price recovers when battery operators learn. If they're wrong, that $57 is just what the market is worth now. This is how the company is playing the data center opportunity without betting the balance sheet on it. Helix Digital Infrastructure is a rack-to-grid venture with KKR and the Kuwait Investment Authority as lead capital partners, and the company itself coming in as strategic partner. The commitment is capped at a maximum of $1 billion, and the company states more than $500 million of that is locked behind milestones. The structure the company highlights is a toggle, described as an option, not an obligation. 3 things fall out of it. First, an asymmetric bet, where the company gains preferred access to hyperscaler deal flow without burning its own balance sheet on heavy infrastructure. Second, a mid-teens hurdle, so if a project clears the return bar, they supply the power, and if it doesn't, they decline and ride along purely as a financial investor. Third, maximum reach with heavily capped capital risk. Our read is that this is a well-designed deal for a management team that doesn't want to be holding the bag in 2029. 2 regulatory fights, and the company scores them very differently. In Texas, the ERCOT Batch 0 audit gets called a pause, not a ban, with the PUC and ERCOT process expected to take a few months. The company puts its own impact at 0 in the short term, noting key projects like Comanche Peak target late 2027 anyway. Then it goes further, arguing short-term delays actively benefit the company by flushing unviable, fake projects out of the interconnection queue, and that a smaller queue is a healthier market. On the eastern side, the company calls the fast collocation rulings a major strategic victory because FASI rejected mandatory bring your own capacity rules. The company adds that its own core arguments defending collocation were explicitly adopted by federal regulators, with PJM compliance filings expected in 30 to 60 days. A skeptic would say every company calls a delay a blessing and a ruling a victory. Fair enough, but on the FRC point, adopting somebody's argument is a matter of public record, so we take that one at face value. Here's where the money is actually going, and this page is the cleanest one in the deck. The company estimates more than $10 billion of available cash generation across 2026 and 2027. Roughly $3 billion is earmarked for shareholder returns, and the company states more than $6.5 billion has already been returned via buybacks at an average of $38 a share. Another $4.5 to $5 billion goes to growth investments, named as Cogentrix, Permian Gas, Meta PJM Nuclear, and Helix. And then there's the piece the company itself calls the ultimate KPI, an unallocated bucket of $2 to $2.5 billion, which it says requires mid-teens unlevered returns. So the company's framing is that watching where this specific capital flows next tells you management's true internal view on building new versus buying existing versus buying back stock. I'd go further. That unallocated bucket is management grading its own opportunity set with real money in public. Watch it more closely than anything they say on the next call. This page is the company arguing with itself, and I respect that it exists at all. Management's narrative is that structural demand growth is happening now with PJM at 168 GW and ERCOT at 91 GW. The second level read printed right beside it is that demand is real, but price realization lags. ERCOT wholesale stays stuck at $30 per month, and FY27 sits right inside that time gap. On Helix, the honest note is that the structure is highly conservative, excellent risk control, but it means minimal near-term EBITDA contribution. On reliability, the read is that being reliable does not guarantee high prices, and the July 22 episode proves physical tightness doesn't automatically mean profit when market mechanics fail. The one pillar the company grades as fully credible is capital allocation discipline, with more than $6.5 billion returned and a track record of executing buybacks ahead of schedule. Our take lines up with theirs on that last row. 3 of these 4 pillars are promises about the future, and exactly one is already proven. So what management refuses to answer tells you as much as what they do. The company maps its own Q&A, and the pattern is sharp. On regulatory policy and pricing mechanics, management freely shared exact prices, quoting 30 and 555, and went deep on battery market dynamics. On the 2028 hedging book, the company describes total opacity, with management strictly refusing to reveal proprietary trading and forward hedging positions. On the Helix pipeline megawatts and timelines, the answer was kept intentionally vague because negotiations are early stage. The company's own conclusion is that they will teach the market exactly how the physical grid works, but they drew a hard line at revealing proprietary trading advantages, and the opacity is highly intentional. Now, a bear would say opacity is where problems hide, and that's a fair instinct in any other industry. Our read is different here. A hedging book is a position, and a position you announce is a position somebody trades against you. We'd be more worried if they told us everything. The company lists 4 risks, and I want to rank them for you rather than just repeat them. Number 1, FY27 anchor drag, where the guided drift toward the bottom of the $7.4 to $7.8 billion range becomes permanent because forward curve weakness persists. Number 2, structural ERCOT weakness, meaning the $30 per AMA price isn't a battery distortion at all, but a prolonged reality until load growth physically catches up to supply. Number 3, paper growth, where the $700 million of shadow upside in the Helix pipeline stay locked in unclosed deals instead of turning into actual EBITDA. Number 4, Texas audit timeline drag, where the few months batch zero audit stretches out and delays real market visibility. Our ranking puts 2 and 1 together as the same risk wearing different clothes, and that pairing is the whole bear case. If ERT stays soft, the guidance drifts down and stays down. Everything else on this page is a timing annoyance. That one is a valuation problem. Here's the thesis in one sentence, and the company says it out loud. Physical demand is here now, and the market isn't paying for it yet. The company frames the gap as lasting until roughly 2027 or 2028, and it puts what it calls a fortress balance sheet across that gap, investment grade ratings, plus more than $10 billion of cash generation. The claim is that they can simply wait out the time lag until pricing catches up to reality. So this is an endurance test, not a growth story. Now be honest with yourself about what that means for you. Waiting is free for a company with an investment-grade balance sheet and buybacks running. Waiting is not free for you because your money has somewhere else it could be for 2 years. Those are two completely different clocks, and the company only controls one of them. I'm reasonably confident they survive the wait, call it 85%. I'm nowhere near that confident about what the stock does while the waiting happens. The company closes with 6 things to track, and this is a genuinely useful list. ERC forward curves, called the leading indicator for whether FY27 guidance settles at the bottom edge. The Q3 FY26 earnings call, where a formal update on 26 and 27 guidance is anticipated. Cogentrix closing, where official confirmation unlocks the $700 million of shadow guidance upside. PJM FARC collocation filings expected within 30 to 60 days to clarify fee structures. The Helix joint venture, waiting on the first signed megawatt announcement to prove viability. And the ERCOT battery interconnection queue, where a continued slowdown in applications would support the recency bias distortion thesis. Alright, last thing, radar always leaves you a light. I'm calling this one yellow. The business is flat out impressive, 97% availability through a record heat wave, and a balance sheet most utilities would envy. But the price of power is the one variable management cannot control, and it's moving against them into 2027. Here's what flips me to green, and I'm telling you up front. ERCOT forward curve stabilizing, plus Cogentrix closing, and that $700 million landing inside official guidance. Get both, I change my mind publicly. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.